Good afternoon, everyone. It's great to be back in the saddle. Great to be with you. I'm Brad Macbeth, and we're here to talk about the Simple Plan. This is the Simple Plan Live. Today, we're doing what we're calling episode 3. It's kind of our fourth in a series, but episode 3 of planning your retirement, what that looks like. And we're going to look at that most interesting question of what age are you going to retire at? And the really interesting aspect of that question is, well, what impact does that have? Because people tend to think about, what they're going to do, but they don't consider what the implications are of retiring at a particular age. So we're just going to look today at that very simple thing. What difference does it make if I retire at, for example, age 65, age 67, or age 70? Now, I want to put a little bit of context around this to begin with as to what retirement is. We hear it talked about all the time, and different people have different visions of it. But retirement from a financial planning view is simply this. It's the age at which you are going to shift from living off money that you earn from working, whether that's as an employee or in a business you have, to living off of income generated through your assets. Now, those assets could be savings you have in things like RRSPs, those types of investments, tax-free savings account, could be a pension plan, could be all sorts of different things. But that's what the shift is, the shift from working to earn it, to generate an income and living off that income, to living off an income derived from your accumulated assets, whatever those might be. So, we once upon a time, there was even a financial company named after the notion of Freedom 55, getting out of work by age 55. Well, look, we live a long time now. So there's a number of things there. First off, what is it that you're planning to do when you reach age 55? If that's when you're going to retire, are you just going to play golf for the next 30 years? Do you have plans? For me, I'm quite content to be working. I'm past that age 55 now, but I have no desire to stop working. I enjoy what I'm doing, and now I could. If I stopped working, I could go do things. I could probably pour myself into some of the things that I spend my time volunteering in, and just go after those full time, for example. But everybody's personal circumstances are different. Now, but the thing that you want to be thinking about is, let's say that we start our working life at age, let's call it 23. Maybe you went to school for a while afterwards, you got a university degree, or you apprenticed and developed a vocation of some kind. And so you really didn't start working full time till you're 23. Now, of course, a lot of people start much later than that these days, but let's imagine that. Well, if you're going to retire when you are age 55, that means you've had 32 years of working to accumulate whatever assets it is you're going to live on from there on out. Now, if you reach age 55, your life expectancy these days is probably around age 87 in our part of the country or our part of the world. So you're looking at 32 years. That means that you're planning on working to accumulate for 32 years, and then you're going to live off that accumulation for 32 years. So basically, you have to have done something to have more or less made double a living income during your working life, if those are your numbers. Now, let's say you work to age 65. Well, now that means you've got 42 years. 65 minus 23 is 42, in order to accumulate enough to live for 22 years. Well, that's a big shift. And all sorts of things can happen as we age. we get older, perhaps we're going to need some extra care, and we might need to accumulate some money to deal with that. Obviously, as we get older, we tend not to spend as much because we don't get around as much and we don't do as much as we get well into our 70s and beyond. Of course, when we talk about life expectancy, that number that we quote is actually what's referred to as a median age. That is, half the population lives or dies before that, half the population lives past that. So, for example, if a couple reaches age 65, the potential for one of them to survive to age 95 is, I believe, up around 30% now. So and of course, running out of money when you're really old is a very difficult situation. So you want to be accumulating enough to have that kind of certainty. So we don't want to just accumulate for what might be life expectancy. We recommend, in fact, that you accumulate enough money to have an income that's going to sustain you through to age 100. All right, so a little bit of business here. Of course, you can always find us on Facebook at Macbeth Group. You can also find us on Instagram at Macbeth Group or on Twitter at Cash Coach Canada. We want to thank our sponsors today, GetTheSimplePlan.com. You can go there and get your own personalized life insurance quote. Also, if you're not sure how much you're going to need in life insurance, there's a calculator there at GetTheSimplePlan.com/how much. And as always, we have a special gift for you today. The Simple Plan Retirement Calculator is all part of our series here on retirement. You can find that at bit.ly/SP-RetireCalc. That's all lowercase. bit.ly/SP-RetireCalc. And at the Simple Plan Retirement Calculator, you can do two things. You can calculate how much you're going to need to accumulate in order to live for as long as you plan to be retired, and how much you need to be, so that's your nest egg. How big does your nest egg need to be? You can also then figure out how much money you need to be saving today systematically in order to reach that goal. All right, I'm Brad Macbeth, and let's get down to business. We're going to have a look at what this calculation looks like. So this is just a tool that we use for helping to put plans together for our clients. We've shown this in other episodes. There are many, many factors that affect your retirement, and they're all projections. And so we're going to look today at simply varying one factor, and that is the age at which we retire. And so we have our mythical client here that we've been working with, Jen Snapper. And you saw previously, we got to the point when we were looking at the RSP versus TFSA questions, that we were going to be able to get her an income of about $59,000 a year in retirement. That's starting at age 65. So now, this scenario, I'm not saying that it's perfectly optimized at this stage. It quite possibly isn't, because we've been using it to show a bunch of things. But based on her contributing to her tax-free savings account and RSP, that's what she can expect in retirement, $59,707. That's with her retiring at age 65 and beginning to collect her government benefits at age 65. And just a little side note there, you can determine what age you want to collect your government benefits at. And when I say government benefits, I'm primarily referring to Canada Pension Plan and OAS, or Old Age Security. And there are advantages to taking those at different times. You can take your CPP early. So 65 is kind of the target age, but you can take it earlier than that, starting at age 60. Or you can defer it until later and take it past age 65, in which case you're going to get a greater monthly benefit. If you take it before age 65, you're going to get a reduced monthly benefit. This is also somewhat true for OAS, or Old Age Security. You cannot start drawing that until you reach age 65, but you can defer it. So if you defer it past age 65, again, you're going to get an increased monthly benefit. And so let's have a look. What we're going to do is all we're going to do in this case is vary the retirement age. So we have Jen here, age 65, $59,707. That's at age 65. All right, so let's just go. We have to change a few things to find out what might happen. And where is that? That is, so first we're going to change her retirement age. And by the way, Jen's in Ontario. The reason that matters is because for the tool we use, that gets into taxes as well, and those vary by province. All right, so all we're going to do here is change her age 67. For retirement, it warns us we better go make sure we do the same with whatever changes we're going to make regarding her government benefits. So we go back and we go to the government benefits. Come on. Okay, and we're going to change her CPP. We're just going to switch her to age 67 now. So we're going to change to age 67. You'll see at age 67, her OAS is going to be 114.4% of maximum, which would give us a projected annual pension from OAS of $8,422. Now, we have other assumptions built in here. We've assumed a 2.1% rate of inflation. That's what's happened over about the last 20 years, but there's no guarantee of that. That's one of those things you have to keep checking back from when you make your when you do your annual review of your plans. You see, well, how are those assumptions holding up? All right, so we've changed the government benefits. We're going to change. We have to add some income because we only had her working to age 65. So you'll see here, we want her now to work through to age 67. So we've been indexing her income so that she's getting a 2.5% raise every year. We'll keep doing that, take her through to age 67. All right. And so then we have to change what's called the cash flow managed age, because that's what we're calculating. We're getting our program here to tell us, well, how much money can she have? What is it that is sustainable? That just takes a moment to calculate. There's an awful lot of calculation going on there because it's adjusting TFSA, RSP. I haven't even included new contributions here, which you probably would or should. I'm not going to because it just makes it a little too complicated to run through here quickly. And so finally, we need to just run the sustainable scenario from age 67, and it will calculate what she's going to be able to earn now or live off of. It's earned. Well, it's not earned in the conventional sense. It's derived from her assets. All right, and so we go down here and find out what the magic number is at age 67. There we go. So now it's gone up to $67,779. All right, so just by deferring retirement by 2 years, her annual income has gone from $59,707 to $67,779. So that's about a 15% increase right there. And those are what we call real dollars. So those are inflation-adjusted dollars. We're looking at dollars as if they're in today's dollars. The real number is actually in the first year is about $149,000 we can see here. That's the inflation-adjusted number because in 2052, when she reaches age 67, she's going to need $149,369 to have the equivalent buying power of 67,779 in today's dollars due to inflation. Okay, so that's a fairly big jump. Let's do one more. Let's kind of max it out. Age 70, we'll get her retiring here at age 70. Now, and I'm not advocating for any of these. What I'm pointing out is that you are going to make choices. And so from a long ways away, if you're 30 or 35, it just seems like you're picking a fantasy ride you're going to go on decades later. But, time passes quickly. As we all know, and as those especially with children know, time seems to really pick up speed. And then you arrive at this age and you find out that all the choices you've made have had a profound impact on where you're at. And so most people don't have a plan, don't put a plan together, but you can manage your life very well. And the tools now are fantastic, right? Imagine, 20 years ago, 25 years ago, there weren't even really good spreadsheets to do this with. Okay, so what have we done here? We've changed her retirement age. We have to go and change her government benefits. And again, I'm not taking her savings accumulation past the base age of 65 because we would be adjusting for that as well, which would create an even greater difference. So we'll get her OAS starting at age 70 and her CPP starting at age 70. Save that. Hey, here's the exciting news of this week. You'll notice things are running a little slowly. I finally ordered a new computer. And like everything else in this era of COVID, it's all very painful to shop and try to find stuff. All right, so we're going to add 3 more years of income here. Copy down to age 70. Index. All right, so now we've got her income extended out there. We're going to change her cash flow managed age. One of the interesting, difficult facts to note as we're going through some challenging times in investment markets these days is that for people who are about 5 years on either side of retirement, they're the ones who get hit the hardest in these types of downturns as their kind of their projected savings either don't accumulate to where they were anticipating getting to, or their early years of withdrawal because of the drop in the markets really can devastate their nest egg. So someday we'll do a show about that. There's all sorts of things you can do to kind of provide a base layer of guaranteed sustainable income that can help in case of those kinds of downturns. Okay, no, we already did that. So we're just running the sustainable scenario here now. At age 70, anyway, back to that computer thing, especially because Apple just made a big change. It's very confusing and difficult shopping. However, the good news is things will run much, much faster once we get that beast in a few weeks. All right. So now, age 70, we find she could have $81,414. So $81,414, that is about a 20% increase. So going from 65 to 67, we saw about a 15% increase in projected retirement income. Going from 67 to 70, we see that we're increasing about another 15%. Going from 59 to 81, so 65 to 70, we are looking at about a 25, 30, 25%. Well, let's calculate that out. I like the correct numbers. So we're looking at about a 25 to 30% growth in income. Of course, you can never find that thing when you're looking for it. There we go. I need a better icon. All right, so let's just pull that into our view here. So 81 divided by 59. Oh, sorry, my back of the napkin calculation wasn't right. 36%. So that's real income. Remember, this is inflation adjusted. So real income, by delaying from age 65 to age 70, you can have, in this scenario, you could have 36% more income. And as I said, we didn't even boost up the savings from 65 to 70. If we did that, would have a huge effect. So I really appreciate your comments. So waiting that long to start collecting is crazy. Not really. It's all based on actual actuarial tables, and so you are projected to earn the same amount from that by taking that delay because of the increase, the significant increase you get in your benefits. But it's not just an either or, right? So for example, you could delay retirement to age 70, but choose to start drawing your government benefits earlier. You could take your CPP as early as age 60. One of the interesting things is that almost everybody seems to take their CPP and their OAS at the prescribed ages, 65 and 70, or sorry, 65 and 65. Yeah, they're both 65 now. OAS was 67 for a little bit. So most Canadians, my opinion being that they're just really not paying attention to this stuff much. They just kind of walk in lockstep and take it at age 65. So there's nothing wrong with taking it at age 60. I'm not advocating for it. It's a personal decision, and would really vary depending on your circumstances. But I would say that that's it's a decision you want to be making in the light of some really substantial planning, because these are choices that have an impact on the stage of your life where you're becoming increasingly vulnerable and your ability to make adjustments gets harder and harder. So, you can delay, you can do whatever. A lot of this also becomes a tax question because CPP is taxable. OAS can have an impact on clawbacks, et cetera, et cetera, et cetera. It can become a very complex question because you want to manage when you have taxable income coming to you. Of course, at age 71, you are compelled to begin drawing down your RRSPs at a prescribed rate. That creates a tax situation as well. So many, many different equations there. So what I really just wanted to show everybody today was what's the impact, from as simple a point of view as you can make it, what's the impact of delaying retirement? Of course, it works backward the other way as well. If you said, well, what if I want to go from age 65 to age 60? What impact is that going to have? In fact, let's do that. Let's go back here. So let's see if I decide to retire earlier. We'll do all the same thing. So we'll set our retirement age at age 60. I also think really the biggest question is, what are you going to do with your life? Just in the sense of we all need to have kind of vision and purpose for our life. It's not simply a financial question. And so people just determine, what do I want to do? And so some people might say, listen, I've got some really profound, important things I want to do when I stop working. Others might be like, well, I'm just going to play golf. And they might have said in the past they were going on a cruise. Not sure how much that's going to happen anytime soon now. So let's go adjust our government benefits. We'll put our CPP to age 60. We can't put OAS before age 65, but our tool will calculate all that. See, if we try to go 64, it will say cannot do. So we go age 65. And we save that. And then we have to go adjust our employment income. Now, for the purpose of keeping this simple, because this stuff all gets pretty complex when we're working on real situations for real people, I'm not going to go adjust the investment contribution. So that's going to skew our numbers a bit. So starting at age 61, we'll just make our income 0, our employment income. All right. And as I say, I'm not going to deal with the adjusting the investment, so that's going to skew it a little. And so we then adjust this age to age 60. I think we're going to find this is going to have a huge effect. Bearing in mind that our age 65, we were expecting to get 59,000. Whoop. Come on. We were expecting to get 59,000 at age 65. Let's see what we're going to get here at age 60. And the magic number is, I'm going to say it's going to go down to around 40. Given how big, well, 36% the other way. So let's see the magic number, please. Oh, well, here's the bad news. We don't even have enough money now. Well, it's a bit weird here in these few years. There's a shortfall. That's because we don't have the money really to put into our investments. But we're down here now to $41,000, which is about what I would have expected. It would actually be even less because we weren't working. We wouldn't be making these 5 years of contributions. So let's see. Yep. And in fact, in this case, Jen wasn't even targeted to get her mortgage paid off until age 64. So you'd have to adjust all those things as well. But we can see that's a huge drop. So just looking at that, the difference between age 60 and age 70 for retirement is like going from in the ballpark of $40,000 to $80,000 to live on in retirement. So interesting, good stuff to note. As I say, there absolutely is no right and wrong to any of these questions. It's a matter of taking all the moving parts and figuring out what's the best scenario, what's the optimum scenario for how you are planning to live your life when you retire, which we remember, retirement is when we shift from living off the income we derive from working, whether it's as an employee or in a business or owning a business, to living off the income we derive from our assets, which might be investment savings in RSPs and tax-free savings accounts, could be pensions, whatever that is. So I hope that has helped you today to gain a deeper understanding of what financial planning and retirement planning is all about, what a lot of the moving parts are. It's a complex consideration. There's a lot of tax considerations as well. So it's very important to put together a plan for your life, and it really helps you to rest easy in doing so. So I want to thank our sponsor again today, The Simple Plan Life Insurance. You can get your free life insurance quote at getthesimpleplan.com/quotes. There's quotes there from all major Canadian insurers. You can just find out whether you're paying too much for your insurance or who the best offers might come from these days. If you don't know how much life insurance you should have, you can get that calculation there as well. GetTheSimplePlan.com/how much. And I think I've mentioned before that now is actually a great time to get life insurance because the situation with the COVID pandemic has brought about some temporary shifts. One of which is we don't have to go through nearly as many tests to get a fairly substantial amount of life insurance. You can get up to $2 million worth of coverage right now without having to see anyone other than fill out an application online. And another factor is that with insurance rates as low as they are and anticipated to stay as low as they are, interest rates as low as they are, insurance rates are starting to go up. We've seen that in some of the permanent insurance. It's going to start hitting term insurance probably within the next 4 to 6 months. We're going to start to see term insurance rates rise. I'm not prophesying that. I can't say that for certain, but that seems quite likely. Today's tool, our free gift to you, the Simple Plan Retirement Calculator. You can calculate using that tool how much of a nest egg you need to accumulate to live the lifestyle you want to in retirement, and how much you need to be saving today in order to accumulate that nest egg. You can get the Simple Plan Retirement Calculator at bit.ly/SPRetireCalc. That's bit.ly/SPRetireCalc. And that's all lowercase. I'm Brad Macbeth. Thanks very much for joining us today. You can find us on Facebook at Macbeth Group. You can also find us on Instagram at Macbeth Group and on Twitter at Cash Coach Canada. We'll be back again next week on Tuesday, live again, with the next in our series on retirement planning. Hope you have a great weekend. Thanks very much for joining us. We really appreciate your time. Send us any questions you have. Thanks very much for your comments today. We really appreciate those as well. And we are looking forward to hearing from you. Let us know whatever's on your mind. Any questions you might have, we're happy to answer them. Thanks very much. Take care.